Hello, and welcome to Michell Consulting's webinar series for our Michell University. Today we're going to be working with SAP Business One, and we're going to be talking about the concept of the dropship. For purpose of the demo today, we're going to be using SAP version 9.0 for our demo. So we're going to talk about the difference between regular warehousing and dropship warehouse. So let's begin, and let's look at some of the setup information. So if I go into Administration, and in Administration, I go to Setup, and I'm going to go into Inventory, and let's look at our inventory warehouses. So here you can see that we have 3 warehouses. And you can see that this warehouse is not a dropship. And by the way, you can only have one dropship warehouse. So in this case, Warehouse 1, you can see it's a standard warehouse, which means the inventory is going to come into the warehouse and go out of the warehouse. You can see that we have Warehouse 2, which is the same, and you can see here that we actually have a Warehouse 3, which is defined as a dropship warehouse. So again, we can have one dropship warehouse. This is why this is grayed out. So our Warehouse 3 is going to be dropship. What this means is that the inventory really is not ever going to come into here. It's going to go directly from the vendor to the customer. And let's see how that's going to affect the inventory as well as the general ledger. So we're going to be using Warehouse 3 for our demo. And today we're going to do 2 things in the demo. I'm going to first go through the regular warehouse to show you the effect of the quantities and the general ledger. And then we're going to actually do it with the warehouse. We're also going to go directly to a goods receipt PO and a delivery instead of going through the standard purchase order and sales order. Again, just for purposes of the demo today. So let's actually start with a regular one. So let's go into purchases and AP, and let's go directly to a goods receipt PO. So what we're going to do here is we're going to actually receive merchandise into a regular warehouse. So we're going to go here, and we're going to actually go, and we're going to search an item. And we're going to receive this into Warehouse 1. So we're going to go and we're going to receive a quantity of 60, okay, into this warehouse. You can see our stock that we have. We have 250 in stock, so we're going to receive, let's make this 50. Okay, so we're going to actually, when we do this, we're going to increase our inventory from 250 to 300. We're going to actually receive this information. If we look at the item itself in the item master, you can see here we have our dropship warehouse. And again, you can see what we have. So in the general warehouse, we don't have anything right now, so we're going to receive the 50. And again, the total is going to be 300. Okay, so let's take a look at that. So let's just go ahead and add this. We're going to receive it. Now let's look at what happens. So we're going to go back now to our goods receipt. You can see that our stock went up to 300. If we look in our inventory master, you can see now that we received 50 in Warehouse 1. So we've increased our quantity. We're using a moving average, so we've affected our item cost here. And let's look at the effect of general ledger. So because we received the goods receipts, we're going to go look at our accounting, and you can see that there is a journal entry that this goods receipt PO created. If we look at this, again, we can see the effect. Because we received merchandise and we've affected our inventory, by definition, we have to debit our inventory general ledger account. So our inventory valuations match. So we did that, so we increased our inventory, so we debited our inventory, and our credit is to a temporary account called goods receipt not invoiced. This is the credit. What's going to happen when we create the AP invoice, the AP is going to reverse out this credit and actually credit accounts payable. So let's take a look at that. So we're going to then, let's just cancel this. So let's take this goods receipt and let's copy this to an AP invoice. We're going to go ahead and add this AP invoice. call back the AP invoice. And again, we haven't affected the quantity or the cost. We've done that through the goods receipt. But now, if we look at the accounting effect, what we've done here is we've credited the vendor, which in turn credits the accounts payable account, because as we remember, if we look at our vendor, this is our accounts payable account right here in the vendor file. So what we've done, we've credited the vendor and credited accounts payable, and we've debited the goods receipt. This one also happened to have sales tax on it, so we've taken care of our sales tax expenses. But here you can see the offset. So what we've done in a standard receipt, we've our goods receipt PO, because it affected inventory, affected the inventory side of general ledger. So we debit our inventory. And then what we've done is we've then credited our goods receipt not invoiced, as you can see here. So this is a goods receipt PO. We've done this, and then our accounts payable, or our invoice, reverses this goods receipt and affects the AP and the account for the vendor. So we've done that. Okay, so now let's do it from the standpoint of a drop ship. So we're going to go back into a goods receipt PO. We're going to select the vendor. Okay, now what we're going to do is we're going to go again, we're going to select our item, our same item here. We're going to make this 50 again. But what we're going to do is we're going to change this to 03. Remember, warehouse 3 is our dropship warehouse. So we're going to go ahead and we're going to do a goods receipt. Because we're doing this through a dropship, we're not going to really affect the inventory. So when you see when we're done, our stock is still going to be at the 300 level in standard. So we're going to go ahead and we're going to add this. And let's call it back up. And you can see that our stock did not change, right? Because here, if we look at the item, we're using the dropship. The dropship warehouse is never going to have any quantity because the quantity is going directly from the vendor to the customer. So here, we're not going to have any changes to this. So let's look now. If we look at our accounting, you will notice there is no journal remark. There's no orange arrow here next to the journal remark because, again, we didn't affect the quantity on hand. So in that case, we're not affecting the inventory or any of the general ledger involved in this account. So you can see here we have no effect. Now what we're going to do is we're going to go ahead and we're going to copy this to an AP invoice. Because we're going to copy it to an AP invoice and we have a dropship, again, this is the accounting document. When I add this, I'm going to have to credit my accounts payable account and credit my vendor because I'm going to have to pay this. So when I do it, let's just add here. Let's go back and look, and let's look at the effect of accounting. So what I've done here, again, I have to credit my vendor because I have to pay the vendor the amount, but my debit is to an offset account called cost of goods. Okay, this is coming from the inventory file in the GL account determination setup, depending on how you do it. In this case, what we're doing is we're posting by warehouse. So if we go to our item, you can see here that we're setting our GL by warehouse. So what we're doing is affecting that account through our warehouse. So if we go here and we select our warehouse, you can see here our expense account is coming from here. So this is the standard setup. If you're using Dropship, what you want to do is you want to have this expense account set up to something like that. Typically what we do is we use a different cost of goods. You know, in this case, again, for demo purposes, I'll use the standard cost of goods, but this cost of goods is dealing on really with regular inventory on selling. What I may want to do is underneath my cost, I may have a dropship costing or a GL account for dropship. I can actually put it in here. But that's where it's coming from. It's coming from, again, depending on how you do it. In this case, we're posting by warehouse, so it would actually come from a warehouse. If you were using posting by item groups, let's say, in the setup under inventory, we can do the same thing for item groups. Again, we would change that expense account here for the corresponding item groups. So what we've done here is we create our AP invoice. Again, if we take a look, you can see the difference between a drop ship and a non-drop ship is that the goods receipt on a non-drop ship, the goods receipt, since we're affecting the inventory, what we're doing is we're debiting the inventory account and we're crediting a goods receipt not invoice, a temporary account. And then the accounts payable that comes in for that is going to, again, affect the vendor or accounts payable. I have to do that because I have to update my my aging because I have to pay this bill. And so what I'm doing is I'm actually on a non-drop ship, I'm crediting the vendor, and then I'm debiting or reversing that clearing account, that goods receipt not invoice. The concept of using a drop ship, the difference being, a big difference is when we do a drop ship goods receipt, because we're never affecting inventory, there's no effect of the general ledger on the goods receipt. And then what happens is in the AP, I'm affecting that expense account, or in this case, the cost of goods. So if we look at that, let's go back. Let's go back to our goods receipt here. Okay, and let's recap what we've done. This one here was a drop ship. Because it was a drop ship, there was no effect from the accounting. You can see there's no little arrow here. So there's no effect on the accounting whatsoever. If you look at this transaction, which was a goods receipt affecting the inventory, you can see that this one, since we are affecting inventory and increasing our inventory, you can see that there is a journal remark. Right? So if it's not a drop ship, a standard, what we'll do is our goods receipt PO is going to affect our general ledger because we're increasing the value of our inventory. In essence, we're increasing on him. We're bringing that merchandise into our warehouse. So because of that, I'm debiting my inventory account here, and I'm crediting this pass-through account, this goods receipt not invoice. And then the AP invoice is going to reverse this credit out by debiting this account and crediting the AP. So you can see that when I'm using a drop ship, you can see that this goods receipt PO 305 was a drop ship. Again, we're not affecting inventory, therefore I don't have to affect general ledger. So you can see that there's no journal remark. There's no little yellow arrow here that I can drill into that. And if we look at the effect of accounts payable on our invoices, this was the drop ship. This was the non-drop ship. This is warehouse 1. Again, because of this, you can look at the effect of accounting. Both of these transactions are going to have a journal effect because, again, since they're AP invoices, it doesn't matter if it's a drop ship or a non-drop ship. I still have to credit my accounts payable because I still have to credit my vendor because I have to pay the bill. So I have to affect my aging. So either way, this one was not a drop ship. This was a standard one. You can look at the effect of accounting. Okay. Again, we're always going to credit the vendor because we have to pay the vendor in this case. So we're going to credit our vendor. But in this case, we're just going to debit or reverse that goods receipt not invoice. So we're just reversing that out to compensate for the goods receipt that affected that account. When we're dealing with a drop ship, in this case, this one here, this accounts payable 285 was a drop ship. You can see here, again, the effect on accounting, I'm always going to affect my accounting because, again, I have to credit my vendor. You have to pay it. But the debit or the offset, instead of using that clearing account that was affected by the goods receipt PO, it's going to grab the expense accounts from the GL account determination tables. In this case, we're using this cost of goods because we're pulling this by warehouse. And the reason why we're doing that, if we look at this item is set to set the GL accounts by warehouse. Again, we have the options of by warehouse, by item group, or at the individual item level. So I'm reading the expense account from my warehouse. Right. Now let's look at the sales side. Again, it's going to be the same type of effect on the sales side. So let's go to sales and AR, and let's go directly to a delivery. And let's do the same thing. Let's create a delivery for the regular warehouse and see what happens, because again, since we're using the regular warehouse, we're going to affect inventory because we're pulling the merchandise out of our stock. So you're going to see that there's going to be a journal remark or journal reflection on this delivery. And then we'll do a drop ship. So we'll do both. So let's do a delivery here. Again, we're going to use Earthshaker, and let's do the same thing. Okay, let's choose this item. And you can see here that we're going to use the standard warehouse. You're going to see that there's 300 in stock. We're going to go ahead and ship 10. So again, because we're using the standard warehouse, what we're going to do is we're going to pull these 10 out of the warehouse. So the effect of the warehouse is going to drop. If we look here, we have in warehouse 01, we have 50. So when we're done, we're going to have 40 in stock. We're going to actually ship these 10. And we're going to affect our general ledger. So let's go ahead and add that. Again, this is the non-drop ship, the standard warehouse. Let's go back and take a look at it. And you can see here how the quantity went down. Again, if we look at the stock, in warehouse 1, we went from 50 to 40 because we just shipped 10. Because of that, we've affected our inventory. And because of that, this delivery must now, from the general ledger side, affect general ledger related to the inventory and cost. So if we go here, you can see that on the journal remark, we do have the little orange arrow, and you can see what happens. Again, since we shipped 10 and we reduced our quantity, we're going to credit the inventory to bring our inventory value down because we need to match our inventory valuation. So we're going to bring it down. And the debit is going to be the cost of goods because this is the cost of us handling the merchandise, the cost of selling. So you can see that. And then let's take that into an AR invoice. And the AR invoice is going to, again, affect the customer and affect the sales. That's going to hold true for both affecting the customer on a drop ship and a non-drop ship. Okay, so let's take this delivery. Copy this to an AR invoice. Again, we're using the standard warehouse. Let's turn the form settings on so we can see that. Let's look at our warehouse right here. Okay, you can see this is warehouse 01. So we're going to see that, again, because this is an AR invoice like the AP invoice is a balance due, so eventually I'm going to get paid by these customers, so I need to have this in my aging. So we're going to go ahead and add this. So we're going to call it back up. The one here for 10, we're going to call this back up. We're going to look at the effect of accounting. And again, we're going to see, we're always going to, in this case, we're going to debit the vendor, debit the customer, because that's the effect of AR. And if we, again, look at the business partner, we understand how SAP works. We look at the accounting, the business partner, this is the accounts receivable account. So affecting the accounts receivable account, updating the customer's balance, just like we did with the vendor, just doing it on the customer side. So we're debiting the vendor and debiting AR, and we're crediting sales. Okay, and corresponding, we have sales tax on this. So now let's do the same thing with a drop ship, and we'll see it's going to behave like the accounts payable side. So now we're going to create a drop ship. Okay, so let's do a new drop ship. Again, we're going to call up Earthshaker. We're going to put our item. And again, you can see we have a total of 290 because we took the 10 out of warehouse 1. But here we're going to go and we're going to use our dropship warehouse. So we're going to add this to the dropship warehouse. Again, you'll see that the inventory is not going to change. Okay, because it's dropship, we're still going to have a total of 290, and we're still going to have the 40 here. Let's make that 10. So we're going to add this. We're going to call it back up. And again, you're going to see that the inventory did not change because we drop shipped. So we're still going to have 40. warehouse 1, and we're still going to have a total of 290. And again, you're going to see that there's going to be no effect of the general ledger. Again, there's no yellow arrow, there's no drill down, there's no journal remark. So again, this was a drop ship, so what's happening is we're never going to touch the merchandise. It never came into our building, never left our building, so therefore there's no effect on the general ledger or on the inventory. We're going to now copy this to an AR invoice. Again, you're going to see we're using the warehouse. So we have this total here, and again, the same principle. Because we did this, the customer is going to owe us this money, so we're going to always have to debit the AR and debit the customer to update that. Let's add this. Let's look at the effect. Actually, this one here. You can see this drop ship. If we look at the accounting, again, you can see the same thing. You can see the debit to the business partner, to the customer earthshaker, which is going to debit AR, and you're going to see the corresponding sales. So in this case, what we do is we have this one here. It holds true if we look at this invoice, which is 268. We look at 267, it's the same thing. So from the drop ship, from the AR invoice, they behave the same if it's drop ship or non-drop ship. We're always going to debit the AR, debit the vendor, and credit the sales. Okay, so you can see those hold true for both. The difference being is that the delivery is not going to affect it. Now, one of the things that SAP has with this is you have to understand is because we're not having a cost of goods, if we look here at our gross profit here is always going to show the 100% of the gross profit. Really is, there's going to be no effect because there's no inventory on this information. So you're going to see here that there's no gross profit, there's no cost. What SAP is doing is the cost is being taken care of from the accounts payable side. So if we look at our deliveries, again, let's see how that's being affected. So if we look at our delivery from a non-drop ship here, one, you can see the effect of accounting is going to be a credit to inventory and a debit to the cost of goods. Right? So we're handling that this way. On a drop ship, we're not doing anything here. So on a drop ship, since there's no effect on the inventory and the cost of goods gets affected from the AP. So you can see here that on a drop ship, we have that. On a non-drop ship, we have the cost. On a drop ship, since there is no effect on general ledger, you can see there's no transaction here, the cost of goods is being handled from the AP side. Right? So we can see that here. If we go to purchasing, the same thing holds true with the goods receipt. What's happening here is that because the delivery is not affecting anything, the difference is on the AP invoice. The AP invoice for the drop ship, you can see here, is taking care of the cost of goods. You can see here this cost of goods is being taken care of from the drop ship on the AP, as opposed to the AP invoice for the non-drop ship, the regular warehouse. You can see the difference here. All right. Okay, so that concludes our webinar today. Let's talk about what we went over. We talked about the dropship concept in SAP Business One. How that's set up is by a warehouse. What you would do is you would define your warehouse. And again, you can only have one dropship warehouse. So if you go to Setup, Inventory, and Inventory Warehouses, you can see here I have three. I have O1, which is a general warehouse, which is not a dropship, nettable. I have Warehouse 2, which is the West Coast, which is also nettable. And I have my Warehouse 3, which is the dropship. Once you define the dropship and start using it, you can't deselect the dropship. I already have transactions. The accounting, depending on how you want to do it, dropship, you have to look at this expense account, this first one here. This expense account is going to handle the difference of inventory not being affected. So you have to set this up. And again, depending on SAP, how you want to do it, you can either do it at the warehouse level or at the item group level, or at the individual item itself. So this is the warehouse. We look at item groups. Okay, you can see that the item group in the warehouse is the same information here. Okay, it just depends on how you want to set your system to post. In the purpose of demo, we're posting by warehouse, so we're looking here. If I was doing it by item groups, I can do it here as well. And again, I would change this account to match what I want to do. This is the expense account for the dropship. So because it's a dropship, what's happening is we're not going to affect inventory. So because we're not affecting inventory, when we do a goods receipt, which is a normal way of increasing the inventory in stock, and by doing a delivery, which is a normal way of decreasing the inventory in stock, the dropships do not affect. Because the merchandise is not going to come into our warehouse, it's going to go directly from the vendor to the customer. So when I have a dropship goods receipt, I'm not affecting inventory or quantity at all. Because of that, there's no journal remark. Same holds true with a delivery. When I'm doing a delivery for a dropship, I'm not affecting inventory, so there's no journal remark on the delivery ticket. The difference being is that the cost of goods is being handled on a dropship from the AP side. So when I get the AP invoice, I'm affecting my cost of goods. Since I'm not affecting it from the delivery, because the delivery affects the cost of goods. My AR invoice is going to behave the same. My AR invoice is going to affect the customer. It's going to debit the customer, debit the accounts receivable, and it's going to credit sales. That's going to hold true and not change. Right? What's going to change is on the AP invoice is if the AP invoice is for a drop ship, I'm going to affect my cost of goods. If the AP invoice is for a non-drop ship, I'm going to actually reverse that clearing account, that goods receipt not invoiced. So you can see here, if we look at the AP, again, on the goods receipt PO, with a drop ship, there's no effect on accounting. You can see there's no little arrow here to drill into that. Okay. If I look at the non-drop ship, which is the warehouse 1, again, you can see the effect of accounting. So again, goods receipt, we're receiving merchandise into our warehouse. We're going to debit the inventory, and we're going to credit this clearing account, this goods receipt, not invoice. And then the AP invoice on a non-drop ship will reverse this. An AP invoice on a drop ship will not reverse this. It will affect the cost of goods. Let's take a look at that. So again, let's look at our AP invoice. This is for the non-drop ship, the regular one. You can see the effect of accounting. Again, it's going to be a credit to the vendor in the AP. But again, because it was non-drop ship, I'm reversing that goods receipt not invoiced here. In the case of a drop ship, which is this one here, you can see, again, I'm going to affect the vendor. I'm going to credit AP, credit the vendor, but you can see the debit here is going to be directly to the cost of goods, not the clearing account. So on a drop ship, the cost of goods is not handled from the sales side. It's handled from the purchasing side. It's very important for people to understand because that kind of creates confusion. So what I'm doing is I'm taking care of my cost of goods on the PO side on the AP invoice, not the sales side. Okay, so let's look at the sale. Because normally, again, let's go to the deliveries. If we look at the non-drop ship, the regular one, this is what normally affects my cost of goods. So you can see on a non-drop ship, what I'm doing is since I'm affecting inventory, merchandise is leaving, I'm crediting my inventory and I'm debiting my cost. You can see here, there's the debit to the cost, which on a drop ship, since we're not debiting cost on the delivery, we're handling that on the AP side. So again, if we go here and look at my drop ship, you can see here, Dropship Warehouse, you can see that there is no effect. There's no journal remark. There's no arrow to drill in, so there's no effect on the general ledger. In the case of this, because the only difference is that the cost of goods is being handled not by the delivery, but by the AP. So our AR invoice is going to be the same, as opposed to our AP invoice being different, because in the AP invoice, when it's a drop ship, we're affecting the cost of goods. When it's not a drop ship, we're using that clearing account. So here they're the same. So if I go to this one here, 268, which is the drop ship, you can see the effect of accounting. Again, it's going to be a debit to the AR and a debit to the vendor, and it's going to be a credit to the sales revenue. You can see here. That's the drop ship, and that holds true for the non-drop ship. Non-dropship is 01. So if I go look at the effect of accounting here, same thing, a debit to the AR, debit to the vendor, and a credit to the sales revenue. Okay? That's a dropship concept in SAP Business One. Again, this webinar is being recorded. It's going to be available on our website. You can visit us at www.michellgroup.com to view this, plus our others in our webinar series. And once again, we thank you for your time.